There was an initial drop due to the pandemic, of course, but we have seen a steady increase over the past few months. But the way global mobility is changing, so, rather than necessarily, businesses sending over, swaths of people to another country and doing, temporary location for, a secondment for a few years, it's the individuals that we're seeing, that it's the individuals that are trying to drive this change rather than the employees themselves.
Well, welcome back to the Hot Seat. Delighted today to be joined by Paul Baker from Buzzacott in London. Welcome, Paul.
Thank you, David. It's nice to be here.
You've been on some webinars with us before, so people might be familiar with you, but if not, it'd be great to hear a little introduction about the kind of work you focus on at Buzzacott.
Yeah, so myself, I joined Buzzacott around 13 years ago now as a graduate, part of their graduate programme, and I've been working in the expatriate tax services team throughout that time, and I'm currently a director. Buzzacott themselves, so as a firm, we are a top 20 accountancy practice in the UK. We have around 480 staff in one office in London, located between Bank and St Paul's. We have a satellite office in Hong Kong and a support team in Coimbatore in India. Buzzacott as a firm, we were founded just over 102 years ago, back in 1919, so we've been going quite a long time. And throughout this time, so rather than merging into a larger firm, we have looked to grow from within, and we can now offer over 16 different business lines. So we provide a variety of specialisms, so corporate tax, audit, corporate finance, tax investigations, financial planning. So the services you'd expect of a typical top 20 accounting firm, and of course, expatriate tax services.
Okay, thanks. Is it, you noticed you joined as a trainee, are many of the senior people in the firm, did they join on a trainee scheme? It's a great mark of people, firms keeping people interested and engaged and building their careers there.
Yeah, certainly. I mean, in the expatriate team, we're a team of around 55 dual qualified UK individuals. And of those, probably around 80% joined under the graduate scheme and have worked well. So it's a great place to work. We have being under one roof, we do have built a strong culture among ourselves, and we like to promote from within rather than external hires.
Okay, terrific. Well, we're going to talk about a couple of topics today across general private client trends you're seeing, particularly with a US-UK flavour. We're going to talk about some of the implications of making tax digital, things perhaps other advisors are not so aware of in different parts of the private client industry. And also global mobility is a very strong suit for Buzzacott. It's something that we've talked to many of your colleagues about before. So we'll just kind of see what you're seeing there on the latest trends. So just starting with on the private client work and trends you're seeing. What's a sort of typical client look like for you, perhaps? And how do they engage you in the first place?
So do we have a typical client? So I suppose our typical clients are generally high net worth individuals who are residing in the UK, but they have some kind of US connection. So be that through their US citizenship or UK citizens, holding interests in US partnerships or real estate. So US citizens are subject to US tax on their worldwide income and gains wherever they are in the world. One of the only a couple of countries that do that. And we try and help them navigate the ever-increasing complexities of both the US and UK tax systems while they live here. So we provide compliance services such as preparation of annual tax returns and foreign bank account reports, as well as the bespoke planning. So a large part of what we do, as well as you mentioned, how do clients come to us? A lot of that is when they are initially moving over to the UK. So we do a lot of planning around pre-arrival planning for individuals. Typically, our clients are generally entrepreneurs or senior employees who, alongside their employment or self-employment earnings, do have wealth invested in both the UK and the US, and the complexities that come with that.
Which I imagine are many. If you've got US entrepreneurs coming to the UK, you've got two fairly complex sets of rules. You've also got other things like global intangible low tax income regime. Perhaps you could shed a bit of light on some of the issues that you tend to tackle when someone from the US is moving into the UK.
Yeah, so I mean, one of the areas that I do actually specialise in is controlled foreign corporations, which from a US tax perspective is generally any non-US company where US shareholders have control. So that's being over 50% of the value of the shares or the voting power of the entity. So a typical scenario we come across is where is the issues of US individuals who are residing in the UK, and they look to set up a UK. They're looking to set up a UK limited company. So it's not uncommon for US citizens to realise that the additional burden that comes from this, from both a US reporting and tax perspective. So you mentioned the global intangible low taxed income regime, or GILTI for short. Someone was having a good day in the IRS when they came up with that acronym. So GILTI are anti-deferral tax rules that came into effect in January 2018. And without any elections in place, individuals are required to include on a current basis their share of the underlying company's income each year on their personal tax return, and that's regardless of whether they receive any distributions from that company or not. So that can result in a worldwide tax on the income of a controlled foreign corporation being as high as 80%, which is not ideal. So, I mean, when GILTI was initially brought in, it was brought in for the US-based multinational corporations who were shifting profits out of the US to, low or zero overseas jurisdictions. But unfortunately, it does catch the individual owners of CFCs. So we help talk through the kinds what their options are with that. Generally, we see three different outs, three different selections that are available to individuals to mitigate this potential 80% tax rate. So just talking through them. So firstly, there's a high tax exclusion, where if the GILTI income has been subject to foreign taxes in excess of 90% of the US corporate rate, then generally you don't have to worry about GILTI at all. So 90% of the current US corporate rate is 18.9%, which is conveniently just 0.1% below the UK corporate rate. So whilst most people think that is okay and UK companies don't have to worry about GILTI, because of the difference between the US and UK accounting principles, we often find that the effective rate does fall below that 18.9%, and therefore you can't get out of it using the high tax exclusion. So the other couple of options that we advise on are the check the box election and the Section 962 election. So the check the box election disregards the limited company as a separate legal entity, and the underlying income of the company still flows through to the individual's tax return and is taxed either self-employment or partnership income if there's more than one shareholder. So the benefit of this is you're actually able to take the losses and claim foreign tax credits in respect of the UK corporate tax and the UK taxes paid on the dividends that you receive from that company. And that generally helps to align the US and UK tax treatment, and we quite often see there's no additional US tax burden. But unlike the high tax exclusion and the 962 election, once you opt into this check the box election, you're stuck with it for 5 years. So it's quite a permanent thing.
Okay, well, thank you for explaining that. And just looking ahead, we're still in the early days of the Biden administration. There are reforms coming in. What do you see as the impact? What should people be thinking about doing now? What's the potential to anticipate further changes, particularly with those with a UK link as well as US taxpayers?
Yeah, so I mean, we're getting on both sides of the moment. So there's a lot of proposed changes in both the UK and the US. And as there are proposals, it's making some advisory work in this area quite challenging at the moment, just because of the uncertainty of where things will end up. Having said that, after the campaign promises and proposals by Biden, the House Ways and Means Committee in mid-September published some proposed legislative text, I think 880 pages of it, to raise over $2 trillion in tax revenue to fund this saving plan. So some of the main changes that we're seeing is the IRS are looking to increase the top federal rate of tax from 37 to 39.6%. And then there's a high income surcharge tax, which is an additional 3% on individuals who earn over 5 million. So that gives you a top rate of around 42.6% versus 45% in the UK. So generally speaking, it should have limited impact on US individuals who are living in the UK, because they're still paying higher taxes in the UK. The couple of proposals that will probably have the most impact on us is the increase in the long-term capital gains tax rate in the US. So the long-term capital gains rate applies where you hold assets for more than 12 months. In the past, the top rate has been 20%. That's going to increase to 25%. And that is going to create an issue for individuals living in the UK, because the UK rate is currently 20%. So it's likely that you're going to end up paying 20% to the UK and then top up 5% to the US. So it isn't a marked increase on that. The other major proposal that's been being proposed that isn't actually getting that much attention at the moment is the changes to the foreign tax credit provisions. So currently, individuals can carry forward excess foreign tax credits for up to 10 years, and that can be used for planning purposes around pensions or when you return to the US, and it just helps smooth out the difference between the US and UK tax years. So that's the proposals for that to 10 years to reduce to 5 years from 2022, and that would just be a straightforward cut-off with no transition. Additionally, they are also proposing to abolish the foreign tax credit carryback, and that can be a very viable relief for US individuals who are living in the UK. As I say, due to the mismatch between the US and UK tax years, you can get situations where the individual doesn't pay the UK tax on an item until the following tax year, and if you're not able to carry that back, that could result in some double taxation. So we do have to be careful on that front.
Okay, well, lots to consider there. Thank you for laying all that out. Just moving on to another area, I mean, making tax digital. There were some announcements this week about a delay to April 24 on some of the proposed reforms. It'd be interesting to hear what that announcement entailed, and then further, what will it mean for clients?
Yeah, certainly. So, I mean, making tax digital, this was I think it was George Osborne at the time, back in 2015, when it was first announced. And it's been it's been introduced to VAT in April 2019, but MTD for income tax has been delayed many times over. And as you say, the recent announcement this week that it's been pushed back another year from April 2023 to April 2024. So, I mean, it does give us an extra year to prepare, but it's frustrating in that the goalposts do seem to keep moving. And again, it's hard to prepare to encourage clients to prepare for this when they don't know whether it's just going to get pushed back again. So just generally speaking, from April 2024, if you're a sole trade business owner or landlord with gross income in excess of £10,000, so that's combined gross income, you're going to be required to keep your income and expense records digitally in record keeping software as near to real time as possible. And then that has to be digitally transmitted to HMRC using some MTD compatible software. So under MTD for income tax, it's the end of the self-assessment tax return, in name anyway, probably not in form. But individuals are going to have to make 6 submissions to HMRC every year. So that's going to consist of 4 quarterly submissions, an end of period statement for that business line, and then a final declaration to HMRC. And the final declaration is still a self-assessment form, so it's still self-assessment in just another way. So I think the main people who are going to struggle with this are going to be people who are still using cash books, or people who are not currently undertaking any formal transaction recording, such as landlords. So
do you think people will accept this? Because, particularly the pandemic has perhaps there's more cashless transactions. People acknowledge, think software like Xero and things like that is more part of the everyday now. Do you think or is there going to be pushback from those small businesses, as you say, that have dealt in cash? And also, will the payment dates change? Is that going to be disrupted? Is this more of a reporting thing than actual payment?
I think when it was first announced back in 2015, there was a lot of trepidation, a lot of fear mongering going around about what this is going to mean. But over the it's going to be 9 years since it was first announced, and the world has changed a lot. And I think people now expect things to be digital, things. They expect things to be online. Why can't I do a tax? Why can't it all be automatic? Basically, so I think the level of resistance will be a lot less than what it would have been if it had been introduced earlier. And people are, and with the MTD for VAT being in place for a couple of years now, individuals who are VAT registered are now familiar with these rules, and it's not going to be too different to that in terms of the submission process. One of the things that is going to that could cause some resistance is that HMRC are taking away the option to make submissions via the government gateway, and you can only make it. You're only going to be able to make it via third-party software, and they're relying on those third-party software providers to offer free solutions, which some software providers won't like that.
Yeah.
So I think there will be some resistance, but generally speaking, there will be a lot more acceptance of it now. As I say, it'll be interesting to see what the landlords of this world do, and whether estate agents are going to get into the market of making MTD submissions.
Yeah.
If you've got an estate agent managing that, then why can't they have software that clicks, presses a button and it uploads the data to HMRC? One of the key pitfalls at the moment is that HMRC HMRC are using national insurance numbers to link MTD submissions. So this is going to affect some of a few of our clients who are non-residents or not, individuals who are overseas and have a UK rental property. Then they don't not necessarily have the national insurance number. They'll have a UTR number to submit a tax return, but they're not. So HMRC there's still a few things to iron out on that front. Now you mentioned, is this going to change the payment system? How regularly we pay payments, how regularly we make tax payments. HMRC say no, but give it 5 years and we'll see where we are. It's HMRC after every quarter submission are going to flag up to taxpayers that we estimate your tax liability is going to be X for this year. You may want to consider making a payment. So it's more nudging at the moment rather than a change to the payment system. We're still going to have payments on accounts and a January 31st payment deadline. And
there was even speculation around the tax year, changing the dates to align with calendar year. I mean, I imagine that would be even more of a headache, I suppose, for people to there being a transitional period. But do you see that as something that might come as a reform, just to be more like other countries?
I can't see it now, and that's following the consultation in the summer around basis periods. So people will be aware that there's a consultation on basis period reform, and following that, it's likely that all self-employed businesses, so sole traders and partnerships, are going to have to be taxed on profits earned in the UK tax year. You're not going to be able to choose a different accounting period. So whilst that does sound simple, some businesses do have a legitimate reason for having an accounting date, whether it's commercial reason. So there's a US person involved. At December 31st year end does work, just because everything has to be done on a calendar year basis in the US anyway. So if the proposals do go ahead, then that's going to shift everything to the UK tax year. So whilst there has been talk of changing things to a calendar year to align with 95% of the rest of the world, I don't see that happening.
All right, thank you. And just finally, on the global mobility side, obviously work from home has changed the way a lot of people are living their lives, and people maybe decide to relocate within the UK or into another jurisdiction, and their employer may bless this. I mean, what are you kind of seeing on the tax front from how global mobility is having kind of downstream impacts on people's affairs?
So global mobility is a large part of the work we do, and there was an initial drop due to the pandemic, of course, but we have seen a steady increase over the past few months. But the way global mobility is changing, so rather than necessarily businesses sending over swaths of people to another country and doing temporary location for, you know, a secondment for a few years. It's the individuals that we're seeing, that it's the individuals that are trying to drive this change rather than the employers themselves. You know, it's the individuals. They say, you know, we can work from home now, we can work remotely. We've proven that. So I've got a home out in Maine or Florida, or, you know, why can't I go and work out there? And, you know, it's, on the face of it, it seems simple. You know, I'm still working for a UK company, but I'm just working out of my house in America. But there are a lot of tax implications for that, for both the individual and the employer. We have seen situations where individuals did just uproot and move to their holiday home and didn't tell their employer, and it's landed, you know, there's a lot of issues with that from both a employment tax and a personal tax perspective.
Okay, well, look, it's been great to chat to you today, Paul, and we look forward to sharing this discussion with our members.